Welcome to this short lecture on equity before tax cash flows. Thanks for watching. What we're doing here is we're translating the debt cash flows that we've just learned how to compute into our commercial real estate pro forma framework. We do this helpfully in there's two approaches to this. One is the operational cash flows, the income that we receive from our asset. The other one is the capital cash flows, the cash flows that occur when we buy and sell our real estate investment. I'm going to start with the operational side. We've learned NOI, so up to now we know how to get NOI in a pro forma. What we're now going to do is convert that into what I call an unleveraged cash flow. There's many different terms for this. The whole point is that we take off the actual cash flows that occur during the real estate investment in an income or operational period that we did not include in NOI. So traditionally, this means inducements, our incentives paid to our tenant, the capital expenditures that we incur, or capital reserve savings. Again, assuming that these are not already counted at NOI. If they are, then obviously don't double count these costs. And finally, other irregular expenses. Leasing costs is a very traditional one, right? The result of taking those costs out of NOI give me what I call the unleveraged cash flow. This represents the cash that an investor should be receiving net of all of the costs in each operation, in an operational period for which you've calculated it. Then the next cost that an investor has to pay, an equity investor has to pay, is the debt service payment. So this debt payment in an operational sense is the monthly or yearly or whatever the time step is for the debt service payment. If I take that debt service payment away from my unleveraged cash flow, I'm left with the cash that I can put in my pocket, or my equity before tax cash flow for that operational period. And I do that for every period in my holding period. Shift over to the capital cash flows. This is when I'm buying and selling the asset. So I put purchase price in brackets, not because it's optional, but because I like to think of the signs that we use in a pro forma as representing cash flows away from or to the investor. Away from an investor is negative, to the investor is positive. When we buy the asset, we're paying money. So that's cash moving away from me, the investor. On the other hand, when I sell the asset, I receive money from my buyer, and therefore it's a positive. So if it's that way, then I'm always subtracting costs and fees, right? That's money flowing away from me for the services of brokers or other fees associated with a transaction. That gives me this same line, right? My unleveraged cash flows, just here in the capital sense at the beginning and the end of each period, of each holding period or investment. Now, I'm now going to add or subtract my debt principal cash flows. Now I say this, add or subtract, because when I'm receiving money from my lender, in other words, usually right at the beginning when I take out a loan, I receive money that supports the purchase of that asset. So that's a positive cash flow for me. However, at the end of an asset, when I sell my building, right, I received money from the sale. Now my lender is going to require me to repay the loan. So that is going to be a money flowing away from me. So that'll be a negative. Whatever principal I have to pay back at the end, negative. The net result there, my equity before tax cash flow in terms of the purchase and the sale period. Let's have a look at an example. So here's a very basic example of a 4-period property investment. We've got two things happening here. We've got a purchase and a sale, or three things: purchase, sale, and we've got income over the period. So the income I've already put as my unleveraged cash flows. So this I've already taken off capital expenditures, tenant improvements, leasing costs, and other special costs. So I'm down at the net cash flow that I'm receiving from the asset net of all costs. I then put in my debt service payment, and I subtract the debt service payment from the unleveraged cash flow to represent now the cash that's going in my pocket as the equity investor. So this is money left over after I've satisfied my debt obligations. This is the money that goes in my pocket as the equity investor. So you notice it's the unleveraged cash flow minus the debt payment. In this case, we have an interest-only loan of 6.67% for a $1.2 million loan. In the purchase period, so year 0 today, I bought this asset for $1.7 million, and my lender lent me $1.2 million. So a negative cash flow of $1.7 million, positive cash flow because I'm receiving money as the investor of $1.2 million, meaning my net equity position in the asset is a $500,000 investment. So that's how much of my money I put in that investment. Let's go to the sale. I sell this asset for $1.8 million, and I repay my lender the $1.2 million. Don't forget this step. It's a really common mistake. When you sell the asset, you have to pay back your lender. So my net cash flow at the end of that is a $600,000 inflow of cash to me, the equity investor. Now let me add all that up to get my total before tax cash flow. So this adds up the income side and the capital transaction side to give me a line item representing the money that I put in, right? So my $500,000 investment here, then my net income to the equity stake or the before tax cash flow for the operational phase in each year, plus my final year of income and my net sales proceeds after I paid off the debt, my before tax cash flows from the sale. I put all this together. I can use a financial calculator or Excel to tell me that that gives me an internal rate of return, an IRR of about 9%. Now that's really important for investors that are able to pass on their tax liabilities, so partnerships or REITs, right? The company itself is not then taxed on the real estate investment. It passes that on to its shareholders or unit holders. So for those companies, this is the bottom line. This is the key metric that their investors are looking at. And they have their hurdle rates based on before tax IRRs in this case. So keep practicing your cash flow pro forma accounting, and we'll talk more about how we calculate internal rate of returns once we take into account of tax later in the course.